8%, that's roughly the line. Above it, paying off your debt first tends to be the smart move. Below it, historically, it's actually the wrong one, and pretty much nobody tells you which side of that line you're standing on. You graduate. It's a Tuesday, diploma still in a cardboard tube on the passenger seat, and you're sitting in the parking lot doing math on your phone before you even drive home. $30,000 in federal student loans at 6.5%. A few thousand on a credit card at 24, left over from a semester where the loan check showed up 3 weeks late and rent didn't wait for it. Every finance account you follow is saying the same thing. Debt-free first. Attack it. Don't invest $1 until it's all gone. So that's what you do. Every spare dollar, thrown at both balances at once, loans and credit card. Same enemy, same urgency. Except they're not the same enemy. Not even close. One of these is quietly costing you money the longer you wait to invest instead. The other one is saving you money the longer you wait. Two completely opposite problems, and the advice you're following doesn't split them apart at all. I'm Owen. I make videos about the ownership mindset, and no, this isn't a debt is fine video. Most of it really isn't fine. It's that the blanket version of pay off debt first is quietly right about half your debt and quietly wrong about the other half, and nobody bothers to tell you which half is which. Quick disclaimer before I get into it. Not a financial advisor, not personal advice. This is education. Rates and terms shift, so use this to think through your own numbers, rather than as a rule to follow blindly. So where does 8% even come from? Roughly the long-run average return of the stock market. Not a guarantee, taxes eat into it, markets swing hard, and bad timing matters. Think of it as a rough historical crossover point, not a law of physics. Which means the real question hiding underneath payoff debt first was never actually about debt at all. It was always just this one comparison, weighed with those caveats in mind. Is your rate above roughly 8% or below it? Above it, paying the debt off is close to a guaranteed return, better than the market can reliably promise anyone. Below it, historically, sending that money into the market instead has tended to leave people with more, on average, over long stretches. Let's actually run it. Say you've got $300 extra a month, on top of whatever the minimum payments already are. Low interest case first, $30,000, federal loan, 6.5%, 10-year term, current 2026 undergraduate rate. Throw the extra $300 at it and you're debt-free in about 4.5 years instead of 10. Then you start investing everything, the old minimum payment plus the extra, once it's gone. Or invest the $300 from day one instead, let the loan just run its normal decade in the background untouched. Then once it naturally ends on schedule, start investing the full amount from there. 30 years out. Pay it off first, then invest, about $633,000. Invest from the start instead, about $648,000. Investing wins by around $15,000, just because 6.5% debt turned out to be cheaper than what the market has historically handed back. When I graduated, I did the blanket version of this myself. Threw extra at the student loans and a small credit card balance at the same time, because that's what every single article said, word for word practically. Felt good too, felt like being the responsible one for once. Went back and ran the real numbers years later. The extra payments toward the student loan, specifically, mathematically, probably the wrong move. Not catastrophic. Just wrong, in a way I never once questioned at the time, because the advice sounded so obviously responsible, and because nothing I read ever actually separated the two debts and treated them differently. Now flip it. Same $300, but against $10,000 on a credit card at 24% instead of the loan. Pay it off aggressively first, invest everything after. 30 years out, you land around $745,000. Minimum payments only, invest the $300 separately the whole time, and you end up closer to $721,000. This time paying it off first wins, by about $24,000. 24% interest just isn't something a normal investment reliably beats, not over any realistic stretch of time. Same $300, same 8% assumption, same 30 years, and the winning move flips entirely depending on which side of that one line the debt happens to sit on. Honestly, there's a reason pay off debt first became the rule instead of the threshold it should have been. Debt hitting zero always looks like a win on the surface, even when it technically wasn't the best move, and nobody's writing sometimes keep the 6% loan and go invest instead as a headline. That takes math and a disclaimer most people won't read. So the industry hands out the version that's safe to say to everyone, even though it's wrong for a real chunk of the people hearing it. Not bad advice exactly. Incomplete advice wearing the costume of a universal rule. Mortgages right now sit around 6.5% too. Same ambiguous zone as the student loan, per Freddie Mac's weekly numbers as of this month. Say you've got 20 years left on a $300,000 mortgage at 6.3% and an extra $500 a month to work with. Throw it at the mortgage and you come out around $249,000 after 20 years. Invest it instead, letting the mortgage run its course, and you land closer to $295,000. $46,000. Same logic as the student loan, just with a lot more zeros attached because the loan itself is so much bigger. To be fair to the payoff instinct though, because it's not purely a math question. There's something real in being debt-free that a spreadsheet just doesn't capture. The lower monthly number, the relief of it hitting zero, not owing anyone anything. If that feeling is worth more to you than an extra $15,000 over 30 years, fine. Genuinely fine, that's not a mistake, you're just buying something the math doesn't put a price on. So, practically, sort every debt you're carrying into two piles, above 8% and below it. Takes maybe 10 minutes with your statements open. Above the line, credit cards, most personal loans, some private student loans. Go after it hard. The standard advice applies exactly as written here. No caveats needed. Below the line, federal loans, most mortgages, even the average new car loan these days, which Bankrate has at around 6.9%. Historically, you're often better off making the minimum and sending the extra into an index fund instead. Someone's going to say, Owen, investing isn't guaranteed. The way paying off debt is, 8% could easily be a rough decade instead. Fair. That's the actual risk here. Not a hole in the logic, just the trade-off. Paying off debt locks in a return the second you make the payment. Investing is a bet on history repeating itself, not a certainty. If certainty matters more to you than probability, pay off the 6% loan early anyway. That's rational too, just weighing things differently than pure math would. A while after I split my own debts this way, high rate gone first, low rate left alone and invested around, the student loan balance just sitting there stopped feeling right for a bit. Felt lazy, almost, watching it collect interest every month while I put money elsewhere instead. Had to keep telling myself that letting it ride on schedule was actually the correct call. Not laziness. Even on the months it didn't feel that way at all. If there's one thing worth keeping from all this, pay off debt first was never really a debt question. It was always one number, your rate, measured against one other number, what the market has actually returned over time. Everything else, the urgency, the guilt, the idea that any balance at all makes you irresponsible, that's just noise sitting on top of one comparison. Could the real number be 7% instead of 8? Sure. 9. Also possible, depending which decades you measure. The exact number matters less than actually asking the comparison in the first place, instead of applying the same rule to every balance you owe. Go pull up your actual rates this week. All of them. Line them up against roughly 8% and see where they fall. Some of what you've been attacking might be the cheapest money you'll ever get your hands on. And this channel is basically a running list of moments where the common advice and your actual numbers stop matching up. Stick around if that's useful. Drop your biggest debt's interest rate in the comments. Curious how many of you are sitting right on that line without knowing it.